Silver did not crash because its value disappeared. It crashed because the market structure broke. On January 30th, over $50 vanished from silver in a single session, the largest collapse in decades. But while the paper price imploded, physical silver did something far more disturbing. It became harder to find and more expensive to secure. This video is not about headlines or opinions. It is about mechanics. Who was forced to sell, who was positioned to win, and why the future's price may no longer reflect reality. If you want to understand what actually happened in the silver market, subscribe to Economic Mechanics and let's get into it. On January 30th, silver did not correct. It did not pull back. It did not consolidate. It collapsed. In a single trading session, the price fell from above $120 to nearly $70, over $50 erased in hours. This was not volatility in the ordinary sense. It was a structural break, the largest one-day percentage decline in silver since 1980, occurring in a market that had been celebrated only days earlier as a textbook bull run. More than $7 trillion were wiped out across global asset markets in less than 48 hours. Leverage across commodities imploded simultaneously. Retail traders were liquidated at scale. Margin calls cascaded through futures accounts with mechanical precision. Yet even as panic dominated headlines, the price action itself told a more specific story. Silver fell more than 3 times as much as gold. Gold dropped roughly 9%. Silver lost over 30%. That asymmetry is the starting point, not the footnote. If this move were driven purely by macro forces, dollar strength, interest rate expectations, central bank signal, and gold and silver should have behaved similarly. They are both priced in dollars. They both react to monetary tightening. Instead, silver was annihilated, while gold merely stumbled. That divergence is not noise, it is evidence. Mainstream coverage reduced the event to a single catalyst: the nomination of a new Federal Reserve chair, perceived as a monetary hawk. Higher rates for longer, stronger dollar, weaker metals. That explanation is convenient, clean, and incomplete. It accounts for the direction of the move, but not the magnitude, the speed, or the internal mechanics of the collapse. Going into that week, speculative positioning in silver was extreme. Futures data showed net long exposure near historic highs. The market was crowded, leveraged, and one-sided. When price momentum stalled, the structure beneath it could not hold. Large leveraged ETFs were forced to rebalance into a falling market. Billions of dollars worth of silver exposure had to be sold regardless of price. This selling was not discretionary. It was mechanical. At the same time, futures exchanges raised margin requirements in the middle of the decline. That single decision amplified everything. Higher margins during a sell-off forced traders to either post more capital immediately or exit positions at market. Many could not meet the new requirements. Positions were liquidated automatically. Each liquidation pushed prices lower, triggering more margin calls, which triggered more selling. The feedback loop fed on itself. This is how markets break. Not because fundamentals vanish overnight, but because leverage compresses faster than liquidity can absorb it. What makes this event different from previous silver crashes is not just the scale of the move, but the concentration on the other side of it. While thousands of traders were being forced out, one entity was positioned to benefit from exactly this sequence of events. A single participant held an unusually large short position going into the collapse. Built gradually over months, expanded aggressively as prices peaked, and maintained through the liquidation phase. This does not imply foreknowledge. It does not require conspiracy. It requires only an accurate read of positioning, leverage, and reflexivity. When a market raises fourfold in under a year, the hidden risk is not valuation, it is structure. Excess leverage creates fragility. Once that fragility is exposed, price does not move smoothly, it gaps. The January 30th crash was not a judgment on silver's long-term value. It was a judgment on how the market was positioned. And that distinction matters, because leverage events resolve positioning, not supply-demand imbalances. When the forced selling ends, what remains is the underlying market reality. This is why the price collapse, dramatic as it was, did not answer the most important question. It raised it. If silver was truly worth $70, the story would end here. But it did not, because while paper prices were imploding, something very different was happening beneath the surface. Every major market dislocation creates two groups at the same time. The visible group is easy to spot. liquidated traders, forced sellers, accounts wiped out in hours. The invisible group is harder to see, but far more important. These are the participants positioned to absorb the chaos, not emotionally, but structurally. The January 30th silver collapse was no exception. While most of the market was trapped on one side of the trade, one participant was positioned precisely where the pressure would flow. This was not a last-minute bet. The position did not appear overnight. Exchange data shows it was built methodically over several months, starting well before silver reached its peak. Early attempts were not perfectly timed. There were losses. At times, the position was reduced. At others, it was rebuilt. This was not reckless aggression. It was patience combined with conviction about market structure. By late January, that position had reached the scale that stood out even among professional traders. Tens of thousands of futures contracts, representing hundreds of tons of silver equivalent, large enough that it could not be ignored, yet small enough relative to total open interest to remain within exchange limits. This balance matters. Market crashes are not caused by single positions. They are enabled by crowding. But when crowding on size determines who survives the unwind and who benefits from it, the timing is what makes this case remarkable. In the final days before silver peaked, the short position expanded significantly. Not after the collapse began, not during the panic. At the top, this was the moment when speculative enthusiasm was highest, when retail participation was most aggressive, when leverage was at its most unstable. That is when the bet was increased. It is tempting to frame this as inside information or manipulation. That framing is unnecessary and unhelpful. Nothing in the data requires it. What it does require is a deep understanding of positioning, liquidity, and forced behavior. When leveraged longs dominate a market, the risk is asymmetric. Upside is incremental. Downside is discontinuous. This trader had seen this pattern before, not just in silver, but across commodities. Parabolic moves do not end with gentle reversals. They end with air pockets. When prices accelerate faster than physical settlement can justify, leverage fills the gap. Once leverage reaches saturation, the smallest catalyst can trigger a cascade. What followed validated that thesis. As price broke lower, forced selling did the work. ETF rebalancing added volume at precisely the wrong moment. Margin hikes ensured that leveraged longs could not wait for a rebound. Liquidity vanished. Bids pulled. The market fell through levels that had never been tested under stress. The profits generated during this phase were not the result of pushing the market lower. They were the result of staying solvent while others were not. That distinction is critical. In leverage-driven collapses, price is set by who must trade, not who wants to. The forced participant always loses to the optional participant. But focusing only on the trader misses the larger point. This position mattered not because of its size, but because it revealed how fragile the silver market had become. One concentrated short could not have succeeded without a system primed to unwind violently. The structure made the outcome possible. More importantly, this episode did not end with the crash. The liquidation resolved speculative excess, but it did not resolve the question of supply. Futures markets can clear paper positions quickly. Physical markets cannot. And as the dust settled on January 30th, the behavior of physical silver began to diverge sharply from the paper price. This is where the story stops being about a trader and starts being about the market itself. Because even after the largest one-day collapse in decades, the silver market did not behave like a market that had found equilibrium. It behaved like one that was still under strain, just in a different place. If the January 30th collapse were a genuine repricing of silver, the aftermath would have been uniform. Prices would have converged across markets. Arbitrage would have done its job. Cheap silver in one location would have been bought, moved, and sold into higher-priced markets until the gaps closed. That is how a functioning global commodity market is supposed to work. That is not what happened. In the days following the crash, silver began trading at radically different prices depending on geography. On Western futures exchanges, the price hovered around levels implied by the collapse. In Asia and parts of the Middle East, the same ounce commanded dramatically higher prices. The spread was not marginal. It was structural. In some cases, the difference exceeded 40% for the same physical metal on the same day. This is not volatility. It is fragmentation. Under normal conditions, such price gaps should not persist. Professional arbitrage desks exist solely to exploit them. Buy low, sell high, capture the spread, repeat. The fact that these gaps remained open for days tells us something fundamental. The arbitrage mechanism was no longer functioning. The reason was not ignorance. It was cost and availability. Borrowing silver to settle arbitrage trades had become prohibitively expensive. Lease rates surged as demand for physical metal increased and available inventory tightened. When borrowing costs rise sharply, they erase theoretical arbitrage profits. Add shipping, insurance, time delays, and counterparty risk, and the trade stops making economic sense. At the same time, physical availability deteriorated rapidly. Dealers in multiple regions reported that silver bars were simply not available, not at higher premiums, not with longer delivery times, not at all. Inventory was exhausted. Any metal that appeared was sold immediately. This was not a retail phenomenon driven by coin buyers. It was wholesale demand overwhelming supply. This is the critical disconnect. The paper market was signaling abundance. The physical market was signaling scarcity. These two signals cannot both be correct for long. Futures prices are discovered in markets dominated by leverage and netting. A single ounce of physical silver can support hundreds of paper claims. That structure works as long as most participants are content to roll contracts rather than take delivery. When confidence in delivery weakens, the structure becomes unstable. The post-crash price dispersion revealed exactly that, instability. Buyers outside the Western futures complex were not willing to rely on paper settlement. They demanded metal. And when metal could not be sourced easily, price ceased to be a universal number. It became local, conditional, and constrained by logistics. Even more telling was what happened despite aggressive paper selling. Massive volumes of futures contracts changed hands in Asia in a short period, representing quantities of silver far exceeding annual global mine supply. Yet even under that pressure, regional premiums did not collapse. The price fell, but the spread survived. The market absorbed an extraordinary amount of paper supply without resolving the physical imbalance. This is not how a surplus market behaves. In a true surplus, additional selling crushes, premiums, and flushes inventory back into the system. Here, inventory continued to decline. Metal was leaving warehouses. Exchange stocks fell sharply in a matter of days. The drawdowns were not symbolic. They were measured in tons. What this chapter reveals is uncomfortable for conventional pricing models. Silver was not trading at one price because it was not one market. The futures market was clearing leverage. The physical market was clearing scarcity. Those processes were happening simultaneously, but independently. And that raises a deeper question. If the futures price no longer reflects where physical metal actually clears, then what role is the paper market playing? Price discovery only works if delivery is credible. When delivery becomes constrained, price becomes a suggestion, not a settlement. This is the fault line that opened after January 30th, and it leads directly to the structural forces that made this divergence possible in the first place. The most revealing moment in this entire episode did not occur during the crash itself. It came days later, after volatility had already shocked the market. On the morning of February 5th, trading volume in Asian silver futures exploded to a level that defied historical comparison. In a single session, contracts representing more silver than the world produces in an entire year changed hands. Then more traded on top of that. This was not a surge driven by new information about supply or demand. Mines did not shut down overnight. Industrial consumption did not double in a week. What changed was behavior. A massive amount of paper silver was dumped into the market in an attempt to force prices lower and close the gap between futures and physical markets. From a purely mechanical standpoint, the strategy made sense. Overwhelm bids with volume, trigger stops, pressure prices until premiums collapse, reassert control over price discovery. This approach has worked many times in highly leveraged markets where physical settlement is rare. This time, it did not fully succeed. Despite the scale of selling, physical premiums held. Prices in Asia remained meaningfully above Western futures prices, even after the wave of paper supply. Silver entered backwardation, meaning near-term delivery was priced higher than future delivery. In commodity markets, backwardation is not a technical curiosity. It is a signal. It indicates that immediate physical availability is more valuable than promises of future delivery. This is where paper volume stops being impressive and starts being irrelevant. You can trade 1 billion ounces on paper without moving a single bar of metal, but backwardation does not appear because of sentiment. It appears because someone wants delivery now and is willing to pay more for it. At the same time, exchange inventories told the same story. Registered silver stocks declined rapidly. Large withdrawals occurred over consecutive days, not weeks. This was not normal seasonal movement. It was metal leaving the system. Once removed, that silver could not be rehypothecated, lent, or used to back additional contracts. The contrast is stark. On one side, enormous paper volume created the illusion of supply. On the other, physical inventories shrank, lease rates spiked, and availability worsened. The two trends moved in opposite directions. This is the structural flaw in paper-dominated commodity markets. Paper supply is elastic. It can be created instantly at negligible cost. Physical supply is rigid. It is constrained by mining, refining, transportation, and inventory. When these two systems diverge, price becomes unstable. Attempts to force convergence through volume work only if the physical side yields. In this case, it did not. Industrial buyers continued sourcing metal outside the futures complex. Governments and institutions treated silver as a strategic input rather than a tradable asset. Long-term supply contracts bypassed exchanges entirely. This behavior matters more than any single trading session. When large consumers stop trusting exchanges to deliver, the futures price loses authority. It may still move markets in the short term, but it no longer anchors value. What February 5th demonstrated is that the silver market had reached that threshold. Paper selling could still create volatility, but it could not eliminate scarcity. The more aggressively paper was sold, the more clearly the physical constraint was exposed. This sets up an unusual dynamic going forward. Price can be suppressed temporarily through leverage and forced selling, but each episode drains inventory, tightens availability, and raises the cost of maintaining the suppression. System becomes more fragile with every attempt to stabilize it. And that brings us to the final question. If the crash was a leverage event, and the physical market remains constrained, what happens next is not determined by traders. It is determined by structure. The final mistake most observers make is assuming that extreme price moves resolve markets. They do not. They only resolve positioning. The January 30th collapse cleared leverage, flushed speculative excess, and punished crowded trades. What it did not do was create new silver, and that omission matters more than any headline. Silver has been running a structural supply deficit for years. Mine production has not kept pace with demand, and the gap has been filled by drawing down above-ground inventories. That buffer is no longer abundant. Exchange stocks have fallen sharply from prior peaks. Once inventories fall below a critical threshold, the market's behavior changes. Liquidity becomes conditional. Delivery becomes uncertain. Price becomes secondary to access. At the same time, demand is no longer cyclical in the traditional sense. Silver is not being consumed primarily as a store of value or a discretionary investment. It is being consumed as an industrial input. Solar panels, power electronics, data infrastructure, medical devices, and advanced manufacturing all require silver for physical reasons. There is no substitute that can be deployed at scale without redesigning entire systems. Compounding this is a geopolitical shift that most financial commentary still underestimates. When governments begin classifying commodities as strategic, they are not speculating, they are planning. Export restrictions, domestic stockpiling, and long-term supply agreements change the flow of metal permanently. Once silver is absorbed into these frameworks, it does not re-enter the open market easily. Corporate behavior reinforces the same signal. Large industrial buyers are no longer relying on futures markets to source supply. They are securing production directly from mines through prepayment and offtake agreements. This is a rational response to delivery risk. It removes price risk in exchange for availability, but it also removes metal from the pool that futures markets depend on to maintain credibility. This is the core contradiction now embedded in the silver market. The paper system requires confidence that physical supply exists somewhere, accessible if needed. The physical system is increasingly being locked away by entities that have no intention of selling into futures markets. These two systems can coexist only as long as delivery is rarely demanded. The January collapse did not restore that balance, it strained it further. Short-term price forecasts are therefore a distraction. Silver can fall further. It can remain volatile. Leverage ensures that, but volatility is not the same as resolution. As long as physical inventories continue to decline and industrial demand continues to rise, the underlying pressure does not dissipate. It accumulates. Eventually, the market is forced to reconcile paper claims with physical limits. But reconciliation can take many forms. Sometimes it happens through sharply higher prices, sometimes through cash settlement, replacing delivery, sometimes through rule changes that redefine what contracts actually promise. History shows that when these moments arrive, they do so abruptly. The key insight is simple, but uncomfortable. The paper price of silver is a number. The physical market is a constraint. When the two diverge far enough for long enough, the constraint wins. The January 30th crash will be remembered not as the end of a silver story, but as the moment its internal contradictions became impossible to ignore. Not because prices fell, but because they fell while scarcity intensified. That is not a conclusion drawn from belief or optimism. It is a conclusion drawn from structure. And structure, unlike sentiment, does not change quickly. The silver market did not resolve its contradictions on January 30th. It exposed them. Paper prices can move violently in the short term, but they cannot manufacture supply. What we are watching now is a widening gap between how silver is traded and how silver is actually used. That gap does not close quietly. It closes through repricing, rule changes, or shortages that force the issue. Whether silver moves higher or stays volatile in the months ahead matters less than this reality. Markets built on leverage fail when delivery becomes the question. If this breakdown helped you see the structure beneath the headlines, support the channel by subscribing to Economic Mechanics. Share this with someone who still thinks price alone tells the story. I'll see you in the next one.